Welcome back to Revise and Resubmit, the podcast that takes, those really dense academic papers and makes them surprisingly interesting. I'm Pavlov.
And I'm Nikita.
Today, we're digging into a really interesting piece of research, and it's actually part of the reading list for the virtual summer school in Entrepreneurship Research 2025.
Oh, right. That's a fantastic program.
It really is. And, 2025 marks its fifth year. It started back in 2021, and it's a completely no-fee initiative.
Which is incredible, making that level of research accessible.
Absolutely. They structure it with 5 sessions, I believe. Each has 4 papers, plus some occasional book reviews. A great resource.
Definitely.
And we should definitely give a big thank you to the organizers, Professor Vishal K. Gupta and PhD candidate Athena Skiadopoulou. They're both from the University of Alabama.
Yeah, they've done amazing work spearheading that. Really valuable for the field.
Couldn't agree more. So the specific paper we're unpacking today looks at long-term orientation, specifically in publicly traded family businesses.
Okay, that's a fascinating intersection. Family influence in the public markets.
Exactly. The research explores how having that family influence shapes decisions, especially around, how they use resources and deal with risk.
How that family dynamic plays out under shareholder scrutiny. Interesting.
Yeah. So our goal here is to pull out the key insights for you. We'll look at some, maybe surprising differences between these family-influenced firms and others, and what it might mean for their survival long-term.
Sounds good. Where do we start?
Okay, so the paper kicks off by talking about something called a dominant logic. What exactly is that in this context?
Right. Think of dominant logic as the underlying mindset, maybe the core philosophy that guides the main decision makers in the company.
Like their default way of thinking?
Sort of, yeah. It shapes how they see the world, how they approach problems, opportunities, threats, all of that. And in family business research, like this paper points out, there's this strong theme that family firms often operate with a long-term orientation.
Focused on the future, then?
Very much so. It's not just a vague idea. It's often about ensuring the business survives and thrives, for the next generation and the one after that.
So it goes way beyond just hitting quarterly numbers.
Precisely. The literature gives examples, like you see patient capital, meaning a willingness to wait longer for investments to actually pay off. They might also pick industries that are, let's say, less fiercely competitive.
Okay.
And you often see longer CEO tenures in family firms and, importantly for this study, family members sitting on the board of directors.
That makes sense. If you're thinking generations ahead, your strategy is going to look different. Now, this study zooms in specifically on publicly traded family influence firms, or FIFs.
Right.
And how they use resources strategically to manage those long-term survival risks. How do they define family influenced here? It seems pretty crucial.
It is. They define it based on who holds sway in the dominant coalition, the key decision makers. Specifically, they look for firms where the founding family has influence, and the measure they use is having at least 2 members of the founder's family on the board of directors.
2 family members on the board. Why the board specifically?
Well, the thinking is, drawing on other research, that having family members serve together on the board fosters this shared history, this deep commitment to the firm's long-term health.
So that shared perspective at the top level is key.
Exactly. That shared long-term view is then expected to translate into strategies that lower the firm's overall risk profile. It's about embedding that longevity mindset right into the core governance.
Okay, so long-term thinking, driven by family presence on the board. Now, the paper gets into Slack resources. It sounds kind of loose. What does that mean here?
Yeah, it sounds a bit like laziness, but in organizational theories, Slack is actually about having extra resources beyond what's strictly needed for immediate operations.
Like a buffer. Some wiggle room.
Precisely. It's a cushion that allows the firm to adapt, whether it's weathering a storm or jumping on an unexpected opportunity. This study looks at 3 different types of Slack.
3 types. Okay, let's break those down.
First up is absorbed Slack. These are resources already consumed internally, mainly by management. Think salaries, administrative overhead, perks, that kind of thing.
Right.
So the first hypothesis was, do FIFs have lower levels of this absorbed Slack? Are they leaner, essentially?
More frugal with internal spending?
The findings suggest yes, quite strongly. The statistics were very significant. FIFs showed about 10% lower absorbed Slack compared to non-family firms.
10% lower. That's noticeable.
It is. It points towards a preference for conservation, maybe efficiency over just consuming resources internally within the firm.
Okay, conserving on the inside. What's the second type of slack?
That's unabsorbed slack. This is the readily available liquid stuff, cash reserve, easily accessible trade credit, stuff you can use quickly.
Like a rainy day fund.
Exactly. So hypothesis 2 was, do FIFs hold more of this unabsorbed slack?
A bigger financial safety net.
And again, the data supported it. FIFs had about 5% larger pools of this unused liquid capital. It gives them that buffer against negative shocks.
So spending less internally, holding more cash. What's the third one?
The third is potential slack. This is about the firm's capacity to get resources if needed, mainly its borrowing power. Think unused lines of credit.
So how much debt could they take on?
Right. The hypothesis was that FIFs would have greater potential slack. They measured this by looking at the debt-to-equity ratio. A lower ratio means less debt relative to equity, therefore more room to borrow.
Less debt already means more capacity to take on debt later. Makes sense.
And the findings were pretty stark here, too. FIFs had roughly 25% higher potential slack, shown by that lower in debt-to-equity ratio. Significantly more untapped borrowing capacity.
Wow. Okay, so lower internal spending, more cash on hand, and more borrowing power in reserve.
Right.
Across the board, they seem to operate with more cushion.
That's the picture that emerges, yes.
So how does all this different approach to slack connect to the risks they take, the strategic risks?
That's the critical link the study explores next. The idea is that how you manage your slack influences your appetite for strategic risk. So hypothesis 4 is strategic risk lower in FIFs compared to non-family firms?
Okay, but measuring strategic risk sounds tricky. How did they do that?
Yeah, it's not straightforward. They used an established method looking at the shared variance, basically, how much key investment areas move together.
Which areas?
Things like capital expenditures, long-term debt, and R&D spending. The idea is if a firm is making big coordinated changes across all these major areas simultaneously, it suggests a higher level of strategic risk-taking, like making big bets.
Okay, so big synchronized moves equal higher risk in this model.
Generally, yes. It implies potentially large interconnected strategic shifts. And the finding, FIFs showed a strikingly lower level of strategic risk, about 47% lower than non-family firms.
47%, that's huge.
It really is. It strongly suggests a tendency to perhaps avoid strategies with highly uncertain payoffs. They seem to favor predictability. For anyone listening, think about it. Does this match how you see some established family businesses operate? Maybe less likely to chase the absolute newest, riskiest tech.
It certainly fits the pattern of caution. Fewer big swings, maybe fewer home runs, but also fewer strikeouts.
Yeah.
Which leads naturally to the bottom line, I guess.
Yeah.
Bankruptcy risk.
Exactly the final piece. Hypothesis 5 is firm bankruptcy risk lower in FIFs.
And how do you measure that likelihood?
They used a well-known model called the Olson Index. It combines various financial metrics, profitability, debt levels, liquidity, things like that, to estimate the probability of financial distress. Importantly, a lower Olson score means higher bankruptcy risk.
Got it. So you want a higher score. And what did they find for FIFs?
The results were again significant. The Olson Index was, on average, 11% higher for FIFs.
Higher score, meaning lower bankruptcy risk.
Precisely. A greater distance from potential bankruptcy. It suggests their more conservative balance sheet management really does translate into greater financial resilience.
So the whole picture seems very consistent. Lower internal spend, more cash, more borrowing capacity, less strategic risk-taking, and ultimately a lower chance of going bankrupt. It paints these FIFs as very cautious, very focused on the long haul.
Yes, the evidence points strongly towards that conclusion.
Now, didn't the study also look specifically at the founder's role? Even if they were the only family involved?
Yes, they did. That was an interesting side analysis. They found that firms with just a lone founder still involved showed similar tendencies, lower slack consumption, lower risk, though the effects were generally a bit weaker than in firms with multiple family members on the board.
So the founder's DNA, that long-term vision, seems to matter even on its own.
It suggests that, yes, that initial imprint carries weight.
There was also some follow-up analysis about how many family members make a difference, right? Does adding more and more family keep increasing these effects?
Correct. They used a technique called spline regression to see if the influence grew stronger as you added more family members, say, to the officer ranks or the board.
And did it?
Interestingly, no, not really, beyond a certain point. The analysis suggested that the main impact of family influence on these strategic variables seemed to stabilize after about the first 2 family members were involved.
2 members. So it's not about packing the board.
It seems not. Having, say, 5 family members versus 2 didn't appear to make a significant additional difference to slack or risk-taking in the way they measured it. It suggests that reaching a certain threshold, that core presence of 2, is what really establishes that long-term conservative dominant logic.
That's a really key nuance. It's about having that critical mass, not just sheer number.
Unshackled.
Okay, so let's try to sum this up. Publicly traded firms, if they have at least 2 founding family members on the board, tend to operate differently. They exhibit this dominant logic focused on the long term, which shows up as being more conservative with resources, keeping more slack available, and taking fewer strategic risks, leading to a lower probability of bankruptcy compared to non-family firms.
That captures the core findings well. It's compelling evidence for a distinct strategic posture in these family-influenced firms, prioritizing survival through prudence.
And that threshold of about 2 family members seems crucial.
Yeah.
So for our listeners, if you're in a family business, how does this track with your experience? Does this resonate?
And for those in non-family firms, what can be learned here? Is there value in adopting some aspects of this long-term, maybe more cautious approach, especially in volatile times?
It definitely gives you food for thought.
And here's a final thought to leave you with. While this research highlights the stability and longevity that this family long-term focus can bring, could that inherent conservatism also be a double-edged sword?
How so?
Well, could it potentially hinder the firm's ability to innovate aggressively or seize rapid growth opportunities in really dynamic, fast-changing markets? Is there a trade-off between stability and breakthrough growth?
That's a great question. The potential downside of playing it safe. Stability versus dynamism.
It's something worth pondering, and certainly an area for more research.
Definitely. A really provocative point to end on. And don't forget to subscribe to Revise and Resubmit on Spotify and Apple Podcasts. And if you're enjoying the show and want to support us in creating more insightful content, consider becoming a patron on Patreon. Every contribution helps us continue this journey of exploration and discovery. Until next time, keep those minds curious, keep questioning, and keep revising and resubmitting.